Good morning to those of you in Asia. Good evening to those of you in the United States. I'm Steve Orlins, President of the National Committee on U.S.-China Relations, and thrilled to be rolling out another of our two-way investment studies that we do with Thilo Hanemann and the Rhodium Group. It's really been one of the great things over, how many years has it now been, Thilo?
Six or seven? Six.
Yeah. Like this. So it's the sixth year we've done it, and it's terrific because so much of discussion about China is not data driven. It's kind of speculative. It's not really knowing what's going on. And what Rhodium has done in partnership with the National Committee is really produce data to allow policymakers to make hopefully rational decisions. At this program, we're joined by Tim Stratford and Anna Ashton, both of whom are incredible experts in the area. Tim, I've known for more years than I can possibly acknowledge, and he is a partner at Covington Burling, and Anna Ashton is now Senior Director of Government Affairs at the U.S.-China Business Council, with long experience working on China in both the Defense Department, the U.S. Chamber, and the U.S.-China Economic and Security Review Commission. So what we'll do is we'll kick off with Thilo, kind of talking about the data, talking about the results, then turn it over to Tim, who will talk about kind of the view from Beijing, and then turn it over to Anna to talk about the view from Washington. And then I'll ask some questions, and then you are all free to ask questions. And I will look at them and ask them on your behalf. But thank you all for joining us this morning or this evening. Thank our panelists, and Thilo, thank you and Rhodium for really doing such great work with us.
Thank you, Steve, and welcome everyone. I'm very grateful for the long partnership with the National Committee on U.S.-China Relations, and I'd like to thank Anna and Tim for joining us tonight. As always, for the sixth year in a row, my mission is to take 15 to 20 minutes at the outset of this session to introduce the most important data points for this year's report. And I brought along a few slides, which I'm going to put up here. Looks like that was successful. And I'd like to start this presentation with a slightly more historical perspective, since we're in our year 6. I brought with me a chart that shows the past 20 years of U.S.-China capital flows, looking at the two types of investments that we are covering here within the U.S.-China investment project, FDI and venture capital. And when we kind of look back to 2008 and 9, when we had our last a global financial crisis, the story was fairly straightforward and easy. Almost all capital flows between China and the US was US FDI going into China, and not really much else. In part catalyzed by the global financial crisis in 08-09, that created some buying opportunities for Chinese investors, and also a lot of liquidity within the Chinese economy. That fueled that first growth of Chinese outbound investment that you see here in the red bars coming up in 2010-11. And since 2013-14, we've witnessed a very rapid expansion of two-way venture capital as well. Growth in both directions in all two types of flows have driven two-way investment all the way up to around $70 billion in 2016. But looking at the last 4 or 5 years, we've seen the opposite trend again. So since 2016, initially driven by Beijing's decision to backpedal on some of the liberalization steps it had done on the outbound investment side, but then also greater scrutiny on the US side, and certainly the new FIRMA legislation that beefed up the CFIUS investment screening regime is an important milestone. And then the broader disruption in the US-China bilateral relationship, and growing technology competition have weighed on two-way investment flows. And really looking at 2020, adding the pandemic on top of that, we've really come full circle at only $22 billion of two-way investment flows, looking at FDI and venture capital again. So really pretty much back to the same levels as 10 years ago in 2010. And that is, of course, a level that is shockingly low for the world's two largest economies. So moving along, I would like to take a few minutes to just dive a little bit deeper into the patterns that we saw in 2020. Starting with FDI, just getting everybody on the same page. FDI usually captures investments that create long-term ownership with significant ownership control, either greenfield projects or acquisitions of stakes of 10% or higher. And I think the important context around 2020 numbers is that we usually see this type of investment, this type of cross-border investment, drop very heavily during global recessions. So this is a more historical perspective, taking data from the OECD on global FDI flows, and you can see during all three crises that we have on the chart, first 2000, 2001, a big drop in global FDI flows, the next drop in 2008-9, and then exactly the same happened in 2020. So global FDI flows were down about 38–40% last year, just as context for the numbers I'm going to show next. So starting with US FDI into China, our data set covers both greenfield investments and acquisitions. And at the outset, I have to say that it was extremely tricky to compile this data for this year because you had both volatility and then a number of macroeconomic factors that have really distorted the data. Disruptions. In the first half of the year, a large part of the Chinese economy, especially in the first quarter, was largely shut down because of the pandemic. And so a lot of the big construction projects by foreign companies were put on ice. Multinationals have decided to cut CapEx. And so a lot of it came almost to a halt. As Beijing was able to get the virus under control, a lot of that came roaring back in the third and fourth quarter. Very aggressively, as there was a lot of demand from the world for Chinese-made goods and exports, and so we have a lot of volatility related to that, and was very tricky for us to trace back some of these changes. The second factor that was really difficult this year is that we've seen a lot of interventions by central banks in global macroeconomic dynamics. Currency and exchange rates and interest rates have moved fairly wildly, and one of those results is that Chinese FDI data has been very much distorted. And I want to just venture into that really quickly because it is really important for all of us to understand when we discuss FDI figures, and especially when we read about FDI figures in the news. This chart here shows you data on global FDI into China. So the yellow bars that you see here on this chart are quarterly inflows as captured by China's balance of payments statistics, which are generally used by the IMF and others. And as you can see here, in the last couple of quarters, China has been attracting huge inflows of FDI. It was by far the biggest recipient in 2020 of FDI globally, and every quarter since the mid-year, it's been going up and up and up. And in fact, in the first quarter of 2021, China has set a new quarterly record of FDI inflows. Now, the other data set that's shown here in orange is an alternative data set by the Ministry of Commerce that's showing utilized FDI, so money that's actually being approved and spent by foreign companies, more on the real economy side. And as you can see, there's a really, really big difference between the two numbers. And Beijing really likes to tell the story in yellow because it shows China remains very attractive to foreign companies, but a lot of what that difference tells you is that there are what we call intra-company money movements, really distorting those flows. So it's basically multinational companies that have operations in China putting money into China because, number one, you get much better interest rates on your deposits or on risk-free assets. So about 3.5% if you put it in Chinese government bonds, for example, or in a savings account. And two, because of all the demand for Chinese goods and the lack of Chinese tourists, you have built-in currency appreciation expectations when you have your assets in China. So in short, all of these distortions are showing up in those FDI numbers. And while there has been an uptick in foreign investment into China, a lot of the big figure numbers that you read out there are really, really reflecting macroeconomic dimensions and not so much real economy trends. So that was the second really big caveat when you look at some of these FDI statistics. I'm going to go back to our numbers. We are compiling figures based more from the real economy perspective, and doing it that way with all the caveats I mentioned, we come out at the end of this volatile year at about $8.7 billion, which would be about a 33% drop compared to what we've seen in 2019, and a very similar level actually to what we've seen during 2009, the previous global financial crisis. Greenfield investment has generally been holding up, and especially came roaring back in the second half of the year. What was the main difference to last year is that M&A, foreign acquisitions into China, was hit very hard, which is not surprising given all the travel restrictions and challenges for due diligence. And so M&A has dropped to the lowest level in 10 years in 2020 based on the numbers that we've compiled. Taking a quick look at the industry composition of US FDI in China, you're really seeing a broad-based decline across all sectors, reflecting some of these disruptions. Autos has been the biggest recipient in 2020, partially driven by Tesla and other electric vehicle investments being made on the mainland. Food has been very strong in 2020, driven both by organic growth, but also a handful of acquisitions in the food sector. We also record remarkable recovery or uptick in basic materials, which could extend further given that a few US multinationals, including Exxon, have set up fairly significant greenfield investments in southern China. And while some of these trends, especially autos and basic materials, are reflecting some progress on policy liberalization and market access, there are other sectors that have a more mixed track record in terms of policy impact. So we're looking, for example, at the financial services industry. Some firms have made some good progress buying out their joint venture partners, but others, and I think most prominently Vanguard, have moved in the opposite direction and basically given up plans to run a wholly owned mutual fund business in this case on the mainland. So some of the data provide some evidence that those steps are working, but other data points show us that we're not quite there yet, and I'm sure we're going to talk about that a little later when we discuss Chinese policy. Looking forward, the momentum that we saw building in in the second half of the year has extended in the first quarter of 2021 in a very strong way. So when we do this again, hopefully in a year from now, I think we'll look back and we will have seen a rebound in US FDI into China into double-digit territory for 2021. There is very strong investment, especially in greenfield. And I don't think we're going to see a massive growth from pre-pandemic levels, but we'll certainly get to a similar ballpark as in 2018, 2019, based on what we're seeing so far. Moving forward, looking at Chinese FDI to the US, the story is a little bit more volatile. And as I mentioned earlier, Chinese FDI had already declined very significantly from almost 50 billion at its peak in 2016 to less than 10 billion in both 2018 and 2019. That has really continued to move sideways. Our number comes out at about $7.2 billion of completed Chinese investments in 2020. That's a little bit up actually from the previous year, but it was also heavily concentrated, and it was really just a handful of transactions that make up for the total, for most of the total. One of the surprising things, I think, for the broader debate here, and looking back at some of the historical antecedents and some of the work that we've done earlier with the National Committee, is that we're really not seeing a major growth of Chinese greenfield investments into the US, which what you would usually expect when there's trade frictions and trade barriers in place. There is a bit of growth, but we're far from seeing a sort of Japan-style expansion of local manufacturing in the US. And finally, one more item to mention is that we have seen divestitures continue. The big deal was certainly Ingram Micro that was spun off again by now bankrupt H&A Group. We had Wanda selling down some of its stake in AMC, ironically propelled by some of the GameStop-related Wall Street bets dynamics there. And then we also had a big deal, Oceanwide Genworth, falling apart after 16 extensions. So pretty much a continuation of the trends that we've seen in 2018, 2019, and so far no major signs of an uptick. And kind of really going back to last year, I think the big takeaway is we have not seen Chinese distressed asset buying spree in the US, as many had predicted at the beginning of the pandemic. And while I do expect some recovery in 2021, we have a lot of persistent Chinese policy barriers, and then certainly regulatory and political risk remains very strong on the US side as well. Industry distribution, we really don't need to talk much about that at this low level. Remarkable perhaps that entertainment and consumer products are the single biggest sectors. So industries that are maybe not initially jumping out in terms of national security sensitivity, not surprisingly. And kind of looking forward, the big question for me is whether an overall improvement in political relations or a less volatile policymaking style by the Biden administration can inject enough confidence that deal making in some of those non-sensitive areas is coming back. And then the second element, of course, is whether the outlook that the Biden administration could keep some of the tariffs in place for longer could finally lead to a greater propensity on the greenfield FDI side on behalf of Chinese investors. Moving on to the venture capital side of our data set. Also, just as a reminder, venture capital refers to early stage technology financing, which usually reflects smaller stakes, but it can include significant influence and oversight. And starting with US venture investments in China, historically, looking back, US companies, US investors have always played a fairly significant role in nurturing the Chinese tech ecosystem, going back all the way to the early 2000s. But it really started increasing and growing rapidly in 2013, 2014. And reached its height so far in 2018 with more than 500 individual investments and close to $20 billion invested, which reflects a lot of late-stage funding rounds for gigantic Chinese tech companies. Since 2018, we've seen a big drop in both the number and especially the value of US venture capital in Chinese startups. The single most important variable is not policy, but a very sharp cool down in China's technology sector. So just to give you a dimension, in 2017, 2018, we had around 14 to 15,000 individual funding rounds for Chinese companies on the mainland. That number has come down all the way to about 4,000 to 5,000 in 2020. So a big, I wouldn't say burst of the bubble, but a significant slowdown in the Chinese venture capital mania that we've seen, which is reflected here in the numbers. But certainly political variables have also been important. We've seen much greater scrutiny for US investors, big venture capital investors, in terms of their patriotism or funding problematic Chinese technology companies that are associated with problematic types of technologies. And we certainly also have seen much greater regulatory risk being injected into the venture capital sector overall, with Beijing's crackdown on technology firms, and then more recently with the random political interventions in IPOs and other market exit strategies, of course, most prominently embodied by Ant Group's failed IPO in Hong Kong. In terms of industry trends and technology trends, there are a lot more details in the report, but I thought I'll bring one chart with me here today that shows the decline in US funding for Chinese tech companies, comparing 2017-18 with 2019 and 2020. And not surprisingly, almost all industry verticals or technology verticals see a decline. The big and only outlier really is life sciences, where investment still continues to grow and continue to grow the past 2 years. And perhaps the sectors that are worth mentioning as being less prone to slowdowns are big data, artificial intelligence, and manufacturing. So these tech verticals have seen greater than average interest by US investors over the past 2 years compared to the overall set of Chinese tech companies. Switching over to the other direction, Chinese VC in American tech startups, that has been not a major story before 2014. Almost no flows existed, but then ramped up really quickly, and then in part triggering that FIRMA legislation in 2017-18. Similar to US venture investment in China, 2018 was the high point so far, and activity has declined since then, both in volume and value terms, but certainly not as sharply as flows in the other direction. For 2020, we see some quite interesting patterns here. As you can see from the line, the transaction count has declined further to about 250 individual fundraising round participations, but the investment value actually went up compared to 2019 due to a number of fairly big later stage funding rounds, including Tencent, I believe, invested in Reddit, for example. So it is a reflection of the maturity of the companies that was invested in, and certainly also valuations in the US have gone through the roof over the past 18 months based on the pandemic and other dynamics. Looking forward, I think broadly speaking, Chinese interest in the US sector, in the US tech sector continues, but regulatory scrutiny, of course, remains a major variable. there is especially some uncertainty about pharma enforcement in terms of venture capital and smaller stakes. But the broad context of US-China technology decoupling is also looming over this this type of flow, with a lot of new initiatives, partially coming from Congress, that could reshape US-China technology dynamics, and I'm sure we'll talk about that more in the discussion. This is the same perspective as I've showed before for US VC in China. So this compares Chinese interest in US startups at the peak 2017-18 versus 2019-2020. And we're seeing very similar patterns. The single biggest attraction remains life sciences, oncology, health tech related investments. And we're also seeing anything related to big data, AI, and fintech. And of course, over the past 12 to 18 months, cryptocurrency has become a major attraction as well. Those tech verticals are holding up better than the average. Before setting up for the discussion and transitioning over to more of the policy side of things, I'd like to summarize one more important trend that is really important for the 2020 picture. As I explained, we have initially focused on FDI exclusively, and then over time added venture capital as an important area of public policy interest. Fast forward to today, one of the most important areas of policy interest in Washington and elsewhere right now is portfolio investment. So financial holding of equities and bonds. And that has become an interest in Washington and elsewhere because there have been some very important changes on the policy side that have reignited some of these flows. China has traditionally been very cautious to not allow those kind of short-term inflows, or only allow them in a very constrained manner through specific channels. In the past 2.5, 3 years, Beijing has moved fairly rapidly to create additional channels for foreign inflows into onshore Chinese bond and equity securities through stock and bond index inclusions, stock and bond connect schemes, and other things. So what you see on this chart here are quarterly inflows. So everything above zero is inflows, foreigners buying Chinese bonds and stocks, and everything below is outflows. And you can see that inflows have really gained traction based on some of these policy changes, along with some of those macroeconomic dynamics that I described earlier. And so you have a lot more activity in those passive portfolio investment channels. And there's a lot more interest from the DC side on what that means in terms of pension funds holding potentially problematic equities and the likes. Similar to FDI and VC, the data situation is very, very murky because these flows are very quick, and they're often intermediated through offshore locations. And while it is not possible for us to track these kind of transactions based on the same type of bottom-up methodology that we use for FDI and VC, what we've done is we have in January released a report that tries to take stock of these flows and corrects the official figures for some of these distortions. And we find that US-China portfolio investment or financial flows, financial investment totals more than 3.3 trillion at the end of 2020, which is twice as much as what the official figures show. So a quite interesting additional layer on top of FDI and VC, and I encourage all of you to check out that report, which is publicly available on our website, and it is an important additional story for 2020 and beyond. moving over to the discussion part, let me just take another 2 minutes here just to maybe set the table a bit more for the Q&A. Going into 2021, the expectation is very much that along with a normalizing global economy, we should see some of these flows going back to pre-pandemic patterns and normalization of both FDI and venture capital flows after an abnormal 2020. At the same time, there are a lot of uncertainties, both in terms of markets as well as policy, and just putting up some of the things that we are watching for 2021 in particular. On the Chinese side, one of the things that was the most puzzling to me or the most surprising to me is how strictly China continued to control capital outflows throughout the second half of 2020. We had massive inflows, a lot of appreciation pressure on the currency, yet there wasn't really any movement to let households or companies, private companies, take greater amounts of money outside of China. So there was a very strict continuation of that conservative stance towards capital outflows, and I think going forward that remains one of the single most important policy items to watch. Market access, of course, remains important. There's been some progress, but certainly not enough yet to say there's really a level playing field for foreign firms in China. And I'm sure Tim and Anna have a lot to talk about that. Dual circulation and this broader push for greater technology independence is another important variable that is important for both the inbound and outbound side. And then finally, from a long-term perspective, one really important question is to what extent this formalization of portfolio inflow channels could create an alternative option for some foreign investors, talking private equity firms and others, to generate China exposure without actually owning the whole thing on the ground. Switching over to the US side, as I said, I think one of the most important questions is whether that return to due process and a more normal policy, a greater balance between different agencies in the interagency process for CFIUS, for example, could re-inject, could regenerate some of the trust among Chinese investors to put money into US operations in non-sensitive sectors. There is some uncertainty still about implementation of the defensive policies that have been enacted, most importantly, FIRMA and ECRA, but then we also have a whole slew of next generation policies that are being cooked up right now in Congress and within the administration on supply chain safety, antitrust competition policy, data protection, industrial and tech policy. So there are a lot of new initiatives that could change the game for quite a few Chinese market participants. And then last but not least, I think it is really important to kind of broaden it a bit more from the bilateral relationship to take into account broader geopolitical developments. We are seeing quite a few signs that there is more of a coordinated approach within the OECD in key regulatory areas like investment screening and export controls, especially apparent in Europe at the moment. And then, of course, one layer above those narrow regulatory questions is this broader discussion that is happening in Canberra, in Berlin, in Washington about the overall compatibility of the Chinese economic system with market economies that could also have a big impact on how both US as well as Chinese investors feel about future capital deployment in each other's economies. So I'm going to stop here and hope that was an interesting run through data. Pass it back to Steve to get the panel started.
Right. Well, you have packed a ton into that. So let me just turn it over for a perspective on the ground in Beijing to Tim Stratford.
Thanks a lot, Steve. It's really an honor to be invited to participate on this panel with Thilo and with Anna. I think that the study results that Thilo's just shared with us are very, very helpful. It's very, very useful to get this hard data. I would say that the results of the study match what my expectations would be quite closely. And also, I think that the explanations that Thilo's provided for declines we've seen and for other trends also seem spot on. Speaking from the perspective of the business community here in Beijing, I think the biggest questions for us are, where are we headed now? And what sorts of investments make sense going forward? And I would say that uncertainty about these two questions is the largest impediment to future investment. In 1921, we're beginning to move beyond the effects of the pandemic to a certain extent, but travel is still very difficult to and from China. And the borders here are likely to be controlled for quite some time because China has focused on controlling spread of the virus within the country, and they've done a very good job of that. But because most of the population is not yet vaccinated, they still have to focus on border control as long as the pandemic is still not under control in other countries. And so that means it's likely to continue for some time. For this and other reasons, it seems that both the Chinese government and MNCs are reassessing the appropriate role for expats in China. There are a lot of people that just haven't been able to return. And even if the senior people can return, they're not allowed to bring their families. And so companies are reassessing, well, how many expats do we need? And frankly, we're seeing some evidence that at least in some parts of the government, they're also pleased to see companies move to have more of their senior positions filled by PRC nationals instead of by expatriates. And we're also seeing that if you're not in a company that seemed as essential to China's business ambitions, and also if you're staffing an NGO, if you're a teacher at a school, people like this are just having a hard time returning. And so this is affecting the way people are viewing China as a place where they want to have their career to a certain extent. I'd also say that we're seeing that local governments are rather cautious because of political trends. It used to be that local governments would bend over backwards to show that they were still going to be very welcoming to foreigners and to foreign investments and offer special incentives and special accommodations. And now we're seeing that some of the local governments are beginning to feel more cautious because of the general political atmosphere that they feel coming out of Beijing. Of course, local governments still have a strong incentive to welcome foreign investors and try to make things as easy and attractive for them as possible. But there's a bit of more of a hesitancy to do that now that we're seeing most recently. Another effect of the pandemic, besides the travel restrictions and things related to that, have been that there's a heightened focus on supply chain resiliency. And so that means that some companies are deciding to divert sourcing so that it's not all coming out of China, but coming out of some other places. And so I think this is likely to have a long-term impact on some of the investment decisions that are being made. So that's the pandemic. And so I think there's still going to be some longer-term impact of things that people have learned through the pandemic. But in other ways, the pandemic has simply accelerated movements that we've already seen that are driven by other trends. Some of these are economic. For example, China may not any longer be the lowest cost producer. And so that's prompted some companies over the last number of years to begin moving some of their manufacturing out of China. But also, I think most of the trends that are having the biggest effect are related to the geopolitical situation. The different paths being taken by the two countries, each country's more determined response to actions being taken by the other country, and also diminishing long-term prospects that people in various industry sectors see for successful investments in the other country. So in short, the business community is acknowledging that US-China relations have irrevocably and fundamentally changed following each government's more determined efforts over the past 4 years to address some longstanding issues. And it seems clear that negotiation of a new basis and rules of engagement between the two countries is going to take several years. And so businesses are going to have to leverage a solid understanding of the underlying dynamics in order to be able to navigate what we expect will be a pretty prolonged period of uncertainty. So why do I think that this uncertainty is going to be relatively long lasting? Well, first of all, I think China is largely waiting for the US to get its act together. You don't have significant policy changes all of a sudden in China, but you have a new US administration. And so the new US administration is doing a review to come up with a new China policy. But at the same time, they're also doing a review to come up with a new trade policy that reflects priorities in the Biden administration that are quite a bit different from what we've seen in traditional trade policy going back the last decade or two. So that's an undertaking that's underway. And then after we have a new China policy and a new trade policy, we need to have a new China trade policy that needs to fit in with that. And then these policies need to secure consensus within the executive branch and with Congress. And then the administration has said that they're not going to just be unilateral in the way they approach China. They're going to coordinate much more with like-minded trading partners. And so there has to be some consensus building with other countries. And all of these new policies and consensus building exercises are not going to be easy because there are a lot of complex issues and priorities that are pulling in opposing directions, and you have to find the right sort of balance. For example, USTR's trade agenda for 2021 lists 9 priority concerns that they want the trade policy to address. What is it going to mean to have a more worker-centric trade policy? And how is that going to affect our trade relations with other countries? And how is it going to affect the trade policy that we come up with China? But there are a whole list of these priorities that have to be balanced. And also, our trade policy needs to be recalibrated to be more coordinated with our national security concerns. I mean, one of the reasons that I think the original trade negotiations between the US and China broke down was because, on the one hand, Ambassador Lighthizer was pressing China to reduce some of the subsidies in key high-tech sectors. And at the same time he was doing that, other parts of the US government were trying to cut off China's access to some of those technologies. And if you're the Chinese government, the only reasonable conclusion is we'd better double and triple our subsidies rather than move in the direction that the USTR is trying to push us. And so we have to coordinate our national security concerns with our trade policy. So then, when the US has figured what its positions are going to be and is aligned with like-minded trading countries, then the trade negotiations with China will really be able to begin. But the US and China have to establish a new framework for how they're going to conduct these discussions. And these are issues that have generally proven intractable in the past. So these are the things that have to be sorted out. And as long as this is happening, I think there's going to be a lot of uncertainty about investment. And I think the trend that Thilo's data showed that the investment has been in decline over the last number of years is a reflection of these underlying concerns that remain unresolved. So in the meantime, as companies are looking at investment decisions, we need to understand the goals and the concerns of both governments related to our own specific industries, because this is a very industry-specific analysis. And then in our companies, we need to fashion strategies that will reasonably address the goals and the concerns that both of the governments have. Then we need to maintain good lines of communication to make sure that what we understand is current. And then we need to prepare backup plans for alternative scenarios in case they unfold, because there are certainly a lot of different ways some things might pan out. And so that's sort of where we're sitting today. Companies do not want to leave China. They see market opportunities. They see the value in the bilateral relationship. But as long as these uncertainties exist, I don't think we're going to see major changes away from the trends that this new study have pointed out. And I'll leave my introductory comments at that point.
Okay, and I was hoping we'd hear slightly more an optimistic view than that, but okay. Let's turn to Anna, because I'm not sure Washington is going to be a heck of a lot more optimistic than that, but give us the perspective from DC.
Yeah, sadly, I don't think that I'm going to be able to shine a happier light on things. So Thilo noted that Congress is busy cooking up all kinds of legislation, and Tim mentioned the uncertainty driving reluctance by companies to move forward with investments, really in both directions. I'm going to focus mostly on Congress, and yes, indeed, they are busy cooking China-related legislation that is only deepening the uncertainty. In this Congress, we're currently tracking 158 or so China-related proposals. We're currently on pace to outstrip China proposals in the last Congress, which topped 550. And to put that last Congress's China proposals in perspective, comparing the last Congress's China proposals to the 107th Congress's proposals to do with counterterrorism, and that was 2001, 2002, right after the attacks. There were only 105 counter-related proposals during that, despite the bipartisan resolve to ensure that there was legislation to help prevent any future terrorist attacks in the United States. So by that measure, the sense of China as a menace among members of Congress right now and for the last couple of years would seem to far exceed the sense of Al-Qaeda as a menace in the immediate aftermath of 9/11. To put it in a different perspective, though, maybe a more positive light, there were 16,000 bills and resolutions introduced in the last Congress, and as is customary, only a fraction of those, 344, became law. And of the 344 passed, related. To add context and reason to remain calm, while we have an awful lot of China-related proposals already circulating in this Congress, they too are just a fraction of the 5,000 or more bills and resolutions that have been introduced since January. Lawmakers are still actually mostly focused on domestic issues such as the coronavirus pandemic, economic recovery, and confirming Biden administration nominees, but China is a real hot button issue, particularly in the Senate right now. And because the Senate has been so busy, I wanted to run through what's on the agenda there. Some of it involves specific efforts to limit Chinese investment, but the scope of the Senate's efforts to address the China challenge, as they call it, is really far broader. That context, I think, is important to understanding that there are real political factors here in the United States that are creating a climate that is anything but inviting to Chinese FDI. Majority Leader Chuck Schumer has repeatedly stressed since February that he wants to expedite legislation to address the China challenge, and this is widely seen as a bipartisan priority. He brought his much touted China package for a cloture vote this week, finalizing what's in the package and ending debate on it. He said he will bring it to the floor for Senate passage sometime before May 28th, when lawmakers leave for Memorial Day weekend. Maybe he won't, but that is the stated goal. The Schumer package came together as the United States Innovation and Competition Act of 2021. The cloture vote for the bill was 86-11. It can now go to the floor for a final Senate vote, which could happen again anytime in the next few days or the next couple of weeks. And it includes several bills from different committees in the Senate that are bipartisan bills that were rolled into this package as amendments. There's the Endless Frontier Act, which was introduced originally by Senator Schumer and Senator Young, and came out of the Commerce Committee. There's the Strategic Competition Act from the Foreign Relations Committee, the Safeguarding American Innovation Act from the Homeland Security Committee, and the Meeting the China Challenge Act from the Banking Committee. This has been a highly fluid situation for a couple of months now, but the idea from the start has been to get enough senators behind the bill to achieve a supermajority or better, so that the House opts to not mess with the text and just takes the bill straight to the floor. Pelosi can very probably be counted on to put it right on the floor if it goes to the House. And we know there's ongoing communication between the chambers, but it isn't yet clear to us what the real support is on that side or how many votes we should ultimately expect the bill to get on the Senate side. It's odds of passing in the Senate are looking strong based on cloture, but the votes against cloture may be telling. The 11 no votes were all cast by Republican senators. And the immediate big standouts here were Senator Crepo and Senator Risch. since their ranking on finance and foreign relations respectively, and both committees were closely involved in this process from the beginning. Rich indicated during the Foreign Relations markup of the Strategic Competition Act that he wasn't in favor of it being attached to a broader China package, but he didn't seem adamant, more like leaning no. And Crapo is a little bit less surprising of a no vote, since Senate Finance Republican members have expressed reservations about the speed of this process and aspects of the bill from the beginning, and there's no finance provision that's been included in the bill. So it's possible that these Republicans will influence the final vote in the Senate so that there's not as significant a majority as is the goal. Maybe they'll tip the scales a little bit, but I think the odds are low. Rundown of what's in this package. The Endless Frontier Act is the anchor for the Senate China package. It's a multi-billion-dollar funding proposal that would make domestic investment in research, development, and manufacturing in 10 critical technology areas, a lot of which overlap actually with China's Made in China 2025 plan. It's important to note that although it's billed as legislation to compete with China, most of the Endless Frontier Act focuses on building out domestic infrastructure to be competitive with China. Certainly the funding is aimed at domestic rather than foreign companies though, and Chinese companies in general are explicitly excluded from receiving that funding. The Strategic Competition Act from Senate Foreign Affairs it went through markup and passed through committee late last month. Nothing here was specifically investment focused, but Chairman Menendez in his remarks during that markup framed the bill as an unprecedented bipartisan effort to mobilize all United States strategic, economic, and diplomatic tools for an Indo-Pacific strategy that will allow us to truly confront the challenges China poses to our national and economic security. That's a quote. Noteworthy components of the final version include funding for supply chain diversification, which has been mentioned already, several provisions to compete with China's Belt and Road financing globally. It also calls for dialogues with US allies on technology standards, as well as a Committee on Foreign Investment in the United States review mechanism for foreign contributions to higher education institutions above a certain threshold. And perhaps most striking among the bill's provisions, though not explicitly about investment, is a requirement for a diplomatic boycott of the 2022 Beijing Olympics. That was introduced by Senator Romney and Senator Kaine, and it would ban US government funding of any official delegation traveling to the Olympics. It doesn't mention a commercial boycott, and it still allows for athletes to participate. And there's a clause that would allow the Secretary of State to waive the diplomatic boycott if conditions justified it, but that made it into this final China package that Schumer will be holding a vote on. Another piece, the Safeguarding American Innovation Act. That is a bill that was reintroduced from the last Congress by Senator Rob Portman, Republican of Ohio, and it would address Chinese investment in US research and higher education beyond some of the provisions that are already in the Strategic Competition Act. In the 116th Congress, the last Congress, Portman and Senator Tom Carper, head of the Senate's Permanent Subcommittee on Investigations, ran a year-long study that culminated in a committee report on Chinese threats to the US research enterprise, and the introduction of a previous version of this bill happened in 2020. There are provisions of this bill that aim to secure US research and innovation, particularly in higher education institutions, from foreign interference and unsanctioned use. Among other things, it would establish a Federal Research Security Council, detail new, more comprehensive and more uniform requirements for federal grants, information sharing and insider threat assessments, and lower the reporting threshold for foreign gifts to university and research institutions. Then there's the Meeting the China Challenge Act, finally, from the Senate Banking Committee, which was introduced by Chairman Sherrod Brown and Ranking Member Pat Toomey. It restricts commercial engagement mainly through a combination of sanctions and export controls. The sanctions front, it urges stepped up use of mandatory sanctions to address a variety of issues with China, including forced labor, Hong Kong, economic espionage, fentanyl, illicit trade with North Korea, and it articulates new sanctions requirements to address Chinese cyber attacks and IP theft. On the export controls front, it requires a 180-day review of export controls on items that could be used to facilitate human rights abuses. It requires the Secretary of Commerce to coordinate with other agencies and determine within 60 days whether additional export controls are needed to protect human rights. The review would include assessing end use and user risks associated with human rights abuse, and determining if greater controls should be placed on items with critical capabilities that can enable activities like censorship. And then there are a bunch of reporting requirements that could lead to more legislation that would further restrict the ability to do business between our two countries. And this is just one package. There's a ton of other legislation out there that would prevent Chinese companies from listing on US exchanges or would kick them off of US exchanges, and many other things. But this is the package that is moving right now that has the greatest chance of passing and making a significant impact on the shape of the future commercial relationship.
Great. Okay. All very meaty. And I guess first question would for Thilo, because this will then, if I can follow up the question for Thilo to Tim and Anna. What's the data show for Europe? So have they had similar declines, or are we seeing trade and investment diversion based upon US policy?
That is an excellent question, and let me maybe answer it by saying Chinese outbound investment has dropped globally. Especially on the M&A side, it's not a specifically US-driven phenomenon. We have Chinese investment peaking in 2016, 2017 across the OECD and really across the world, and coming down every year since then. Europe has been holding up a little better in 2018, 2019 in terms of attracting Chinese FDI, but in 2020, Europe has actually been falling even more than the US. So it's really not a phenomenon that's isolated to the US. And I would certainly say, looking forward, given the introduction or tightening of investment screening regimes across the EU and a broader reckoning or discussion that is happening within Europe about economic relations with China, I don't really see a great difference anymore in terms of scrutiny, both politically and regulatory, comparing Europe with North America.
And Tim, do you hear the same then from your Chinese clients that are thinking about putting, a manufacturing facility, I have heard from people, where they were considering investing in the United States for a global facility, and they directed it actually not to Europe, but to Canada, because they couldn't export back to China because of the retaliatory tariffs that the Chinese put back in place. But that's one anecdotal example.
Well, I don't have all the data, but if you just try to do an analysis, if you want to sell into the two largest markets in the world, the United States and China, you're better off investing and manufacturing in a country that isn't having these kinds of trade frictions with either one of them. If you manufacture in the US, you'll sell into the US market, but you might be caught going to China. If you manufacture in China, you might be caught going the other direction. So a lot of the things that are going on are they're certainly not necessarily leading to a lot more investment in the United States in a lot of cases. With respect to Europe, I think that Europe has a lot of the same concerns about China's industrial policies and their state-led economic development model that the United States has. And it plays out a little bit differently in different countries because they may have different footprints in their own economies and how China's policies affect them. But I think that there was an effort to try to close the gap between China and the EU a little bit with the comprehensive agreement on investment. But the Chinese have succeeded in really angering a lot of people in Europe because of other developments, sanctions of European officials and so on. And so I think that at the end of the day, I agree with Thilo that investment in Europe and going between Europe and China ultimately are going to face a lot of the same issues and uncertainties and challenges that US-China investment flows face.
And Anna, is there awareness in kind of the Senate and the House? You talked about all this legislation about the need to do this multilaterally, or else we're effectively playing whack-a-mole. So we stop them from doing it here, but it just pops up in other places.
Yes and no. I think, there are certainly members that understand the importance of a multilateral approach and are big supporters of Biden's, commitment to a multilateral approach. But I think also it's not Congress's job to carve out a multilateral approach. And there are plenty of members who just feel that they need to do what they can that's in their lane to react to what they perceive to be the challenges China presents. And I think the biggest thing that is worth consideration in terms of how this is all going to shake out for commerce is that a lot of Congress's activity is really driven by national security concerns, geostrategic concerns about the relationship, which is a real change from the last 20 years or so, where it felt much more like the commercial relationship was driving big decisions about what our bilateral ties would look like. And those national security concerns do also have a thread that is, thinking about how to ensure that the U.S. is competitive vis-a-vis China now and in the future. But that's not necessarily cleanly tied together with the national security concerns. So there are all sorts of proposals that are about ensuring our competitiveness and proposals that are about ensuring our national security. But there's like a bit of a disconnect maybe between those two. And I'm not sure that we're going to end up, if these things move forward, it's not clear to me that we'll end up in a more secure or more competitive situation as compared to China.
I would actually think that it is the responsibility of legislators to craft legislation that only imposes restrictions on Americans when it's done multilaterally. That imposing it unilaterally simply punishes Americans and does this whack-a-mole. I think you mentioned, Anna, that they're now, the Trump policy to delist a bunch of Chinese companies is now creeping into legislation. This is without regard to the accounting issue. The accounting issue, getting Chinese companies granting access to their books and records, the Chinese are willing to do that. That can be solved very quickly. And that was blocked by the previous administration. But this delisting of CNOOC, of China Telecom, China Mobile, is basically punishing Americans, punishing Tim's colleagues in New York who were working on IPOs or accounting firms who are working on US listed firms, because that business will simply go to Hong Kong, Singapore, Tokyo, or London. It's the idea that America is the sole capital market may have been true in 1952, but is not true in 2021. So are they aware of this? Or is it just, we're just gonna fight this, and if it means Americans suffer, so be it?
Go ahead.
Go ahead, Anna.
I was simply going to say that I think you have your finger on what may very well be a misestimation by members of Congress of exactly what the United States economic leverage is in the world today.
Yeah.
I would just add that I think this underscores the important role that the business community continues to play and needs to play in U.S.-China relations. It's often said that we've been the ballast in the bilateral relationship in the past. And I think now, even though things are difficult and there's a lot of uncertainty, we need to help people understand what's at stake and sort of the underlying realities of a lot of these policies. I may have sounded pessimistic, but I was trying to be realistic, because I think you can go forward on a more solid basis if you're realistic about what you're up against. I still think companies should be doing business here, and I think Chinese companies should be doing business in the United States, but they really need to do their homework. What are the concerns that the governments have? How can I fashion a policy, a business strategy that will address those concerns so that I'll be on solid footing and be on very defensible footing? And then how can I make sure I stay in contact with the governments so that I understand what they need and so that they understand what I need? Those are things that we can do, and I think that ultimately they will make a big difference. So I'm fairly, I think that we need to be very much engaged and involved in this exercise and not take a passive role at this point.
Yeah.
And Steve, just to add maybe one more data point, right? And so far, when you look at this particular area of interaction, Chinese investors continue to flock, Chinese companies continue to flock to U.S. capital markets. So the concern that Tim and his colleagues in New York are going to be out of work, so far, that all the rhetoric and the threats, that is not spilling over and it's countering some of the market forces. Quite the opposite, right? So Chinese equity fundraising in the U.S. has really reached record levels over the past couple of quarters. So far, those forces prevail, and as Tim said, you have courts looking into it, you have due process, which I think is the really good news here for Chinese companies. That
Thilo, it's marginal. It would have been better without these decisions that the Trump and this delist. So you have to be very careful about NYSE and NASDAQ listed companies versus Hong Kong, London, Singapore, or Tokyo. These, as Tim well knows, these are subject to New York law. It's governed by a whole different regulatory apparatus, which creates jobs in the United States. If the listing is in Hong Kong or the listing is in Shanghai, in Singapore, in truth, for Goldman Sachs, for Morgan Stanley, even for a lot of the global law firms, they have people in all these places. It just moves the business from New York to those places. But there is a cost for American jobs. And it's really important that, as good as kind of our distribution is in the United States and the transparency that our SEC forces on companies, we are killing our role as a global center of the capital market. That the Trump administration and now this legislation is taking business from the United States, predominantly from New York, and sending it out. And not all American companies lose, but Americans do lose. And it's really important the business community understands that and speaks to that, because I think the financial services sector is not the most popular sector in this administration. Thilo, the data, $8.7 billion in economies the size of America and China. It's effectively, it's zero. It's de minimis, isn't it?
It is not what we should expect, certainly from given the level of trade and other bilateral exchange. No arguments here, Steve. But I do think
my question is really to kind of end this on an optimistic note. It is, at these levels, given the size of these economies, and kind of, as Tim knows, my first experience was negotiating investments in China and watching communities in China changed by American investment. And then later, watching Chinese investment change the community in which my brother lived. It literally, they rebuilt, Fuyao Boli rebuilt the abandoned General Motors facility in Dayton, Ohio, and employed 2,500 workers, 2,500 families, got off government assistance. So the question I'd want to end with, how do we reverse this? How do we make Chinese investment, both VC and full FDI, and American investment in China, work for the peoples of both countries? What do we need to do to kind of change what is a deteriorating, what is Thilo has proven is deteriorating data? Who wants to take that first? Tim.
Well, along the lines of what I just said, I think that companies looking to invest in either direction, if we understand the priorities of the government, the Biden administration has made clear that they want a worker-centric trade policy. They've made clear that it needs to it needs to be concerned about disadvantaged communities. It needs to be concerned about the environment. If companies come in with proposals that show that they're addressing the concerns of the government, the local government where they want to invest, and the national government of the country where they're investing, whether it's a Chinese company coming to the States or a US company coming to China. I think there still are very viable paths forward, and I think we need more of that type of activity.
Anna.
Yeah, and I think from a different angle, we also need to be encouraging our government officials to be more precise about exactly what their concerns are with a rising China and what China challenge means, so that the policies that they are promulgating are also more precise and more specific and narrow in terms of the limitations that they create, tailored to the problems themselves, not these broad ideological mandates that probably do more harm than good.
Thilo.
Yeah, it's hard for me to really add, but maybe historically, looking at the creation of CFIUS and some of these other instruments, CFIUS was created to keep the door open by defining what the concerns are and defining what the U.S. government is going to do for a very small set of deals that are concerning. And I think, echoing Tim's and Anna's comments, I think really rapidly figuring out what are areas of concern from an investment perspective, how do we reset these regulatory mechanisms, and how do we give confidence to investors that investments in this particular area are okay or not. I think that really is key, creating that transparency and predictability to market participants to let investments that are mundane and productive happen, and only focus on the ones that are truly problematic.
I see Professor Sullivan asked the same question from Adelphi. Is there any way that, I guess it's almost impossible, Thilo, but to get the data to somehow reflect what percentage of the decision not to invest is based upon CFIUS or FIRMA, or based upon just a general sense of the US, or based upon capital controls, or based upon, it's we always joke about, how if you could create data, would it be 70% capital controls, 30%, the environment in the United States, which is always why I want to see the overlay of Europe.
Yeah, I think if you look at global China outbound data, for example, that is a good indicator with all the caveats. But
doesn't that include BRI though? The global outbound data?
Yeah, it does include BRI, but it is reflective of the domestic conditions and the Chinese policies that are impacting some of these outflows. And I think that's one good way of taking it apart. But as Tim said, a lot of it is very industry specific. Very much depends on the clusters, on the industry dynamics, on some of the macroeconomic setup. So I wish I could code each transaction for the perfect motivation and then come up with a good counterfactual for what would have happened. But the only way to really approach it is to talk to as many investors as possible and tease it out on a more qualitative level. And I think, Steve, going back to your question about capital controls, I mean, that remains a major barrier. On the Chinese side, companies are also tangled up in this broader reset. Are we now supposed to go out and engage, or are we supposed to focus more on new autonomy and independence dogma? So I think all of that is playing through on the domestic side and is impacting the risk appetite of these firms, in addition to greater overseas regulatory scrutiny.
Of course, if you extrapolate kind of the portfolio, forget the VC and the FDI, just the portfolio inflows that are going to be enormous and be increasing, and the financial community's belief that we're seeing an RMB appreciation. Literally in the last few days, we've seen a significant RMB appreciation. I think it's now about 6.4 and change to the dollar, which is a serious appreciation. And what the Chinese government is going to need to think about is easing those capital controls, that ultimately the inflow of too much capital is actually not productive for China either. And I think the PBOC people and the senior economic leadership understands that. So my guess is we will start seeing liberalization, and Hong Kong Connect and these various other things are part of that liberalization.
Well, Beijing, as everybody else, is dealing with the impossible trinity. And so you would have to give up your exchange rate control for that to happen, which is in the current environment a big question. So yeah, those are some of the domestic pressures that Beijing is dealing with.
But we have run out of time. I think this discussion fairly reflects what the data said. that you've kind of heard the description of why the data is what Thilo has reported is, but I think it's very, very valuable to have the data. So Thilo, thank you and your team for putting this together. Tim, thank you for getting up early and being with us this morning. And Anna, thank you for talking to us from the beach. But everybody, thank you all so much for joining us.
Thank you.